Hi, I'm Charlie Jamieson, Chief Investment Officer at Jamieson Coote Bonds, and this is a review of markets in 2023. It's been pretty sunny around the country lately, but it sure wasn't sunny in financial markets in September, with both bonds and equities under sufferance, as central bankers continue to suggest they want to keep interest rates higher for longer and therefore not offer support to the economies as they may weaken into 2024, as is uniformly expected. We're starting to see some cracks in some of the employment data in the US, but broadly, markets have held up much better over the course of 2023 than many had suggested earlier in the year, ourselves included. The resilience has been a little bit of an exception, given the size and magnitude of the interest rate hiking cycle that has preceded this moment. But the long and variable lag is very, very real, and it will hit the economy very hard. We've started to see places like Germany and Holland, big export kind of nations, already into recession. Southeast Asia in particular, China is under sufferance, and clearly the economy is slowing quickly in Australia. Here in Australia, we're throwing people at the problem. We have incredibly high net migration, which is helping our pie get bigger, and it shows growth on a year-over-year basis. But the quality of that growth for those that are inside the economy already, or the real GDP numbers, are very likely to be flat to negative as we go forward into 24. Central banks, whilst they're suggesting they might still have something to do, broadly the world over, we believe, are now at the terminal rate. They have reached that nadir of where they need to be sufficiently restrictive to bring inflation to heel through time. But the energy market is causing some second round indigestions in that process. Clearly, the embers of inflation are not fully extinguished. And should the commodities markets, and particularly energy, get out of control, then it could lead to a slightly higher inflation outcome, albeit nothing like the peaks that we saw in late 21, early 22. Don't forget that oil tends to be a very, very volatile commodity. As we're making this video this morning, it's down 11% in just a few sessions after a spectacular run higher. Again, we think back to that 07-08 period. Oil was trading at $147 a barrel in July 2008, and it traded at $33 a barrel in November of that same year. So if the economy slows enough and demand wanes for that type of product, clearly there's vast speculation in those types of markets. The reversals can be incredibly powerful, and clearly that has big impacts for the inflationary outcomes thereafter. It's almost certain that US inflation will reside between 3.5% and 4% for the remainder of this year, just looking at the base effect and the way that the data will be clicked together, barring an exogenous oil shock. And clearly that can still occur. Saudi Arabia or Putin can pull the puppet strings on supply and change the dynamics of that market very quickly. And that's always a threat as we approach a European winter. Thankfully, last year, the winter was very mild and they couldn't have a huge impact, even though there was a lot of pre-inventory stocking of things like natural gas and the like. As we look forward, we do believe that the global economy will continue to slow and that will start to speed up. We believe that the talks around soft landing is somewhat absurd. We've just had such a violent cycle that it's not going to perfectly just land gently on the runway and everybody can get out and let the plane cool off. That's very unlikely to occur. We're still in the midst of a real bout of regime change and volatilities associated with that. Certainly continue to see that in the bond market. There's major issues in and around the demand for US treasuries. We know that they have very large fiscal spending programs. We don't have the natural buyers that have been there previously, thinking China, Japan, Russia, Saudi Arabia, the Federal Reserve, although they can come back very quickly if they're needed. But for the moment, Treasury yields in particular are moving further higher and they're dragging everything with it. Australian bonds, now global equities, Australian and international equities. None of that is enjoying higher financing rates through time. And with the US expected to spend 6% budget deficit into 2024 presidential year, very unlikely to cut spending, then the market's looking ahead and saying, you've just got a lot of bonds to issue. We need to keep yields higher in order to draw demand to clear those markets. Now, that's a really important point because those markets will clear, even if it demands higher yields. But what that means, if it does, is that the capital is coming from a different marketplace. And that obviously leaves a sponsorship problem in the riskier parts of the complex. And clearly, we've had a big equity drawdown now from the summer highs, equal or a little bit further than the Silicon Valley Bank drawdown, but we haven't had any of the panic yet. And we know that we do tend to get those moments. So prices can move very, very quickly if that is to come to market. And the wrong combination of news events, weaker economic data, plus the look forward as to very little policy support to prop us up as we've been used to, could cause one of those moments. So it's definitely something investors need to give consideration, particularly as we come into year-end liquidity. We're already now into October, and the year-end is, the years just seems to fly by faster and faster every year, and Christmas will be upon us very, very quickly, and Christmas liquidity with that as economies continue to soften. So it bears thinking about. Our own fund returns obviously draw down in the long duration strategies, pretty close to home in the absolute return strategy. We do believe that bonds are looking compelling value now, particularly in relation to other things. Bonds won't certainly stand still. They're still experiencing volatility, but we do know that in an intense moment of duress, or if we are to have market problems, then government guaranteed incomes are very desirable through time. And certainly, similar to late 2007 when yields pushed higher, that proved to be a wonderful asset allocation for those that are looking to make medium to longer term allocations. Clearly, for the speculators that want to jump in and out short term, the markets will continue to be volatile. Thank you very much.